Tesla's stock has plunged 45% in just a few months, with sales collapsing by 50% in China and declining 29% in Europe. Market analysts point to Trump's new tariffs on imports from Mexico, China, and other key trading partners as the primary catalyst for this dramatic downer. The economic impact extends far beyond Tesla, affecting American jobs, consumer prices, and market stability across multiple sectors. Financial reports show Tesla's market value has been slashed by billions following the implementation of aggressive import tariffs by the Trump administration. The company's second-largest market, China, has seen Tesla sales drop by half, creating an unprecedented opening for Chinese competitors to gain market share. European sales figures similarly show nearly a third fewer vehicles sold compared to the same period last year, putting additional pressure on the company's global revenue streams. Industry experts cite several specific factors behind Tesla's vulnerability to these trade policies. Tesla's production costs have skyrocketed as the company relies heavily on imported components now subject to higher tariffs, explained automotive economists tracking the situation. Their global supply chain is experiencing significant disruptions as factories in Mexico and across Asia face new trade barriers, causing delivery delays and production bottlenecks that directly impact their ability to deliver vehicles to customers on schedule. Investor confidence has deteriorated rapidly, with major shareholders pulling back amid uncertainty surrounding the tariff situation. This has triggered a substantial sell-off in Tesla's stock, compounding the company's challenges. Elon Musk's previous support for Trump's economic policies now appears to be backfiring as these same policies directly impact his company's bottom line. Financial analysts note this represents a significant political gamble that has not paid off as expected. The ripple effects of Tesla's struggles are being felt across the American economy. Vehicle prices have increased by $5,000 to $10,000 as production costs rise dramatically. Over 12,000 jobs in the electric vehicle industry are now at risk, with layoffs already occurring at manufacturing facilities in Texas, California, and New York. Industry analysts warn that this is just the beginning of a potentially larger economic contraction in the automotive sector that could affect hundreds of thousands of workers in related industries. Inflation in the auto industry has surged in response to these tariffs, making both electric and gas-powered vehicles more expensive for average consumers. The higher prices are deterring potential buyers, effectively slowing down the transition to clean energy transportation that has been gaining momentum in recent years. As Tesla struggles, the entire EV supply chain suffers, putting thousands of additional workers in battery production, raw materials, and dealerships in jeopardy of losing their livelihoods. America's leadership position in the global electric vehicle market is increasingly threatened. While Tesla grapples with higher costs and declining sales, international competitors like BYD from China, Volkswagen from Germany, and Hyundai from South Korea are rapidly gaining market share. These companies, less affected by the current tariff structure, are positioning themselves to dominate the future of transportation technology and infrastructure. Industry observers note that once market leadership is lost in such a rapidly evolving sector, regaining it becomes exponentially more difficult. Beyond financial metrics, Tesla is losing something potentially more valuable: customer loyalty. Recent market research indicates that repeat Tesla buyers in traditionally supportive blue states have dropped from 72% to 65%. Even in red states, loyalty has barely increased, moving from 47.6% to just 48.2%. Perhaps most concerning for the company's long-term prospects, 32% of American consumers now say they would never consider purchasing a Tesla vehicle, representing a significant shift in brand perception that could take years to reverse. This erosion of customer loyalty stems from multiple factors. Rising prices have diminished Tesla's former position as an affordable electric vehicle option, with competitors now offering better value propositions. Technological issues persist, particularly with Tesla's full self-driving system, which remains incomplete despite years of promises. Meanwhile, competitors like Waymo and Uber are making significant strides in autonomous driving technology. Additionally, Musk's close political alignment with Trump has alienated a substantial portion of Tesla's traditional consumer base, particularly environmentally conscious buyers who previously viewed Tesla as aligned with sustainability values. Industry analysts suggest Tesla stands at a critical crossroads. To recover, the company must quickly adjust pricing strategies to make their vehicles more affordable despite the tariff pressures. Expanding beyond the U.S. market to regions less impacted by current trade tensions could provide essential revenue stability. Accelerating development of self-driving technology might help Tesla regain its technological edge. Most importantly, the company needs to rebuild consumer trust through improved service, transparent pricing, and consistent product quality. The clock is ticking for Tesla to adapt to this new economic reality. Failure to respond effectively could result in the company losing its position as the world's leading electric vehicle manufacturer, potentially marking the end of an era in American innovation and industrial leadership. Automotive industry consultants suggest Tesla has approximately 12 to 18 months to implement significant changes before market position losses become potentially irreversible. Canada implements energy retaliation against U.S. tariffs, threatening economic stability. In a significant escalation of trade tensions, Canada has implemented a major energy retaliation measure against the United States that could cause gas prices and electricity costs to soar across America. The $110 billion energy relationship between the two nations is now at risk as Canada takes unprecedented steps to counter recent U.S. tariff policies that have strained diplomatic and economic relations between the longtime allies. Canada supplies approximately 4 million barrels of oil daily to the United States, accounting for roughly 10% of America's total crude oil demand. Any disruption to this energy supply represents a potential economic shock to U.S. markets, particularly as Ontario moves to impose a 25% surcharge on electricity exports flowing south across the border. Energy security experts warn this could create vulnerabilities in America's power grid, especially during peak demand periods in northern states that rely heavily on Canadian electricity imports. According to Ontario's Premier Doug Ford, the 25% tariff on energy exports to parts of the United States will begin immediately, with costs passed directly to American consumers. It's hurting workers, it's hurting businesses, it's hurting investments, and it's hurting families on both sides of the border, Ford stated in a recent press conference. It needs to end. That's why I've been crystal clear. Until these tariffs are off the table, until the threat of tariffs is gone for good, Ontario will not relent. This hardline stance represents a departure from Canada's typically more diplomatic approach to trade disputes with its southern neighbor. The impact will be substantial and immediate. Millions of Americans could face electricity bill increases averaging $100 per month. While this might seem manageable to some households, for many residents in affected states like Michigan, New York, and Minnesota, it represents a significant financial burden they cannot easily absorb. Approximately 1.5 million customers across these states will be directly impacted by rising costs of electricity and gasoline, potentially forcing difficult budgetary decisions for families already struggling with inflation in other sectors. Energy analysts warn that if trade tensions continue to escalate, oil prices could jump by 10 to 20%, leading to increased inflation and pushing living costs even higher across the United States. This would deepen the economic shock already being felt in many sectors of the American economy. States heavily dependent on Canadian energy imports will experience the most intense effects, potentially facing energy shortages and disruptions in electricity supply that could create major difficulties in daily life for millions of residents, particularly during extreme weather events. President Trump has characterized Ontario's actions as hostile and threatened to impose additional tariffs on Canadian goods in response. This escalating cycle of retaliatory measures risks creating economic instability not only in the United States, but potentially across global markets. Energy market volatility could drive prices in the U.S. to unprecedented levels, potentially pushing the country toward a more serious financial crisis that would affect consumer spending, business investment, and overall economic growth. Doug Ford has indicated that Canada's response may not end with energy tariffs. He has suggested that additional retaliatory measures could target U.S. exports including wine, food products, and automobiles. This comprehensive approach aims to increase pressure on the U.S. administration to reconsider its tariff policies that initiated this trade conflict. Economic analysts note that targeting multiple sectors simultaneously represents a sophisticated trade strategy designed to maximize political pressure by affecting diverse constituencies across the United States. Under the leadership of Mark Carney, Canada appears to be taking a firmer stance than in previous trade disputes. Carney's strategy extends beyond protecting the Canadian economy from U.S. tariffs. It aims to position Canada as an energy superpower with reduced dependence on the American market. By boosting domestic energy production and developing new trade relationships with partners in Asia and Europe, Canada seeks to minimize U.S. influence and establish greater leverage in global trade negotiations. This represents a significant shift in Canada's international economic strategy, with potential long-term implications for North American energy integration. This confrontation represents more than a temporary trade dispute. It signals a potential reshaping of the North American energy landscape, with far-reaching implications for consumers, businesses, and the broader economy. The question remains how the United States will respond if Canada continues to escalate retaliatory measures, and how dramatically energy prices might rise as this conflict unfolds. Energy security experts warn that dismantling long-established energy trade relationships could create vulnerabilities that would take decades to address through domestic production increases. The timing of this trade dispute adds another layer of complexity to an already challenging economic environment. With inflation concerns persisting and energy markets facing multiple global pressures, the addition of artificial trade barriers threatens to exacerbate economic hardships for consumers on both sides of the border. Financial analysts predict that continued escalation could potentially trigger broader market instability, affecting investment decisions and consumer confidence beyond just the energy sector. For residents in border states particularly dependent on Canadian energy, the consequences could be especially severe. Michigan, which receives significant electricity from Ontario's grid, could face reliability issues during peak demand periods. New York's northern regions similarly depend on Canadian hydroelectric power to maintain stable electricity prices. Minnesota's energy infrastructure is deeply integrated with Canadian systems, making rapid decoupling both technically challenging and potentially disruptive to essential services. Energy industry representatives have called for immediate diplomatic intervention to prevent further escalation. The integrated North American energy market has provided stability and security for decades, noted one industry association statement. Dismantling these relationships over short-term trade disputes threatens long-term energy security for both nations and could create vulnerabilities that would be difficult to address through domestic measures alone. This perspective highlights the strategic importance of energy trade beyond immediate economic considerations. Economic hardship. Who bears the cost of Trump-Musk policies? Elon Musk and Donald Trump have made a controversial assertion that Americans must endure economic hardship as a necessary step toward fiscal responsibility. However, critics are questioning who truly bears the burden of these economic policies and who stands to benefit from them. As millions of American workers face increasing financial pressure, the disparity between the ultra-wealthy and working class appears to be widening at an accelerating pace. Trump's imposition of tariffs on Chinese goods was presented as a strategy to protect American industries and workers. However, economic data suggests that the primary cost of these tariffs has not been borne by China, but rather by American consumers through higher prices, rising living costs, and stagnant wages. This raises fundamental questions about whether current economic policies are creating prosperity for the majority of Americans or primarily benefiting a select few at the top of the economic pyramid. The middle class and working Americans are increasingly finding themselves dragged into an economic downturn they never requested. While Musk advocates for fiscal restraint, suggesting that we must live within our means, critics point out that the consequences of these policies are not equally distributed across society. Billionaires continue to accumulate wealth, while ordinary workers face greater economic uncertainty. Recent economic studies indicate that the top 1% of wealth holders have seen their net worth increase by over 15% during this period of supposed necessary hardship for the general population. Trump and Musk's policies are having measurable impacts on employment across multiple sectors. While Trump promised to help American workers, his trade wars have resulted in thousands of job losses in manufacturing, agriculture, and technology sectors. Meanwhile, Musk has implemented significant layoffs at his companies, affecting many employees who had previously supported Trump's economic vision. These job cuts extend beyond immediate unemployment. They represent billions in lost tax revenue that would otherwise support essential government services for communities across America. The effects of budget cuts are being felt across numerous federal agencies. Reduced staffing at the Internal Revenue Service means fewer taxes collected from wealthy individuals and corporations, effectively allowing greater tax avoidance by those most able to pay. The Food and Drug Administration faces delays in drug approvals due to personnel shortages, potentially keeping life-saving medications from reaching patients. The Consumer Financial Protection Bureau has seen its ability to enforce financial protections weaken significantly, leaving consumers vulnerable to predatory financial practices. These changes raise questions about whose interests are truly being protected by current policies. Education funding has become another flashpoint in the economic debate. Proposed cuts to the Department of Education's budget would directly affect over 7 million students who depend on Pell Grants to afford college. Children in low-income states face diminished access to quality education, while the children of wealthy families continue attending elite private institutions without disruption. Critics argue that restricting educational opportunities creates a less skilled workforce and ultimately hampers economic growth by limiting human capital development in communities that need it most. Perhaps most controversial are the cuts affecting veterans services. Approximately 80,000 jobs are being eliminated from the Department of Veterans Affairs, directly impacting those who serve the country. 1/4 of VA staff are veterans themselves, yet they face unemployment as funding for veteran support programs is slashed. This reduction affects not only medical care, but pushes millions of veterans toward financial insecurity after their service to the nation. Veterans advocacy groups have expressed alarm at the scope and speed of these cuts, warning they could create a crisis in veteran healthcare access within months. Oversight and accountability mechanisms are also being dismantled. Federal inspectors who have historically exposed corruption and saved taxpayers billions through their investigations have been systematically removed from key positions. Agencies like the Department of Labor, Department of Defense, and NASA once provided critical oversight that prevented waste and fraud, but these safeguards are being eliminated. Without proper accountability, government waste increases and corruption thrives at taxpayers' expense, potentially costing billions in misappropriated funds that could otherwise support essential services. The question of who ultimately wins and loses in this economic landscape becomes increasingly clear. Americans continue losing jobs as economic instability grows, with manufacturing sectors particularly hard hit by tariff-induced cost increases. Families relying on steady income face mounting uncertainty as employers respond to economic pressures by reducing hours, eliminating positions, or relocating operations overseas. Education becomes less accessible for millions of students, making it harder for future generations to succeed economically in an increasingly competitive global marketplace. Veterans who risk their lives for their country wait longer for medical care, if they receive it at all. Meanwhile, the wealthy continue sending their children to elite schools and benefiting from tax policies that favor their interests. Trump has attempted to deflect responsibility for the current economic situation by blaming the Democratic Party and encouraging extremist movements like Dark MAGA. His approval ratings have declined as more voters question whether his policies are delivering the prosperity they promised. Polls show significant drops in support from key voter groups, including independents and women voters, suggesting growing disillusionment with divisive political strategies that appear to deliver economic benefits primarily to those who need them least. Despite these challenges, Trump continues to seek financial support for his political campaigns, sending frequent emails urging supporters to donate. These communications often intensify accusations against political opponents, claiming they threaten American freedom and prosperity. By linking these appeals to movements like Dark MAGA, Trump frames political donations as participation in a larger struggle against perceived enemies rather than as support for specific policy proposals that would benefit average Americans. This messaging strategy aims to maintain political support even as economic policies deliver questionable results for many supporters. The dark MAGA movement itself represents a concerning trend in American politics. Presented as a call for hardcore conservatives to escape the influence of the Democratic Party and restore American strength, critics worry it deepens divisions within the country and makes finding common ground on economic policies increasingly difficult. By framing political opposition as existential threats rather than legitimate policy disagreements, this approach potentially undermines democratic processes that could otherwise produce more balanced economic solutions benefiting broader segments of society. As more policies fail to deliver promised economic benefits and political scandals continue to emerge, some former supporters are beginning to question whether current leadership truly represents their economic interests. This growing disillusionment could potentially reshape political alignments, particularly if economic hardships continue to disproportionately affect working-class communities that previously provided strong electoral support. The question remains whether this realization will translate into meaningful policy changes or simply more sophisticated messaging designed to maintain political support despite economic realities. Government contracts and regulatory changes benefit Musk's companies amid growing concerns. In a development raising concerns about potential conflicts of interest, a $2.4 billion U.S. government contract is reportedly being shifted from Verizon to Elon Musk's SpaceX. This controversial decision has drawn scrutiny even among Musk's supporters, who question the process by which SpaceX secured this lucrative deal without typical competitive bidding procedures. Simultaneously, investigations into Musk's companies appear to be disappearing, raising questions about regulatory capture and preferential treatment within federal oversight agencies. The Federal Aviation Administration, FAA, had previously awarded Verizon a $2.4 billion contract to modernize the U.S. air traffic communications system, a critical infrastructure project ensuring the safety of millions of air passengers daily. However, in an unexpected development, the government is now considering canceling Verizon's contract and transferring it to SpaceX without an open competitive bidding process that would normally be required for contracts of this magnitude. Critics question whether this decision reflects genuine technological considerations or represents a strategic move to channel additional billions into Musk's business empire at taxpayers' expense. This contract shift occurs against a backdrop of Musk's public statements that he would avoid conflicts of interest between his business interests and government relationships. However, a pattern has emerged suggesting a new form of regulatory influence. Investigations into Tesla and SpaceX appear to be systematically disappearing or losing momentum after initial findings raised significant concerns about safety, labor practices, and financial disclosures. Government accountability experts suggest this represents an unprecedented pattern of regulatory accommodation that raises fundamental questions about equal application of laws and regulations. The FAA had been investigating a SpaceX rocket explosion that potentially violated safety protocols, but that inquiry has gone silent without public resolution. Tesla was previously fined over $600,000 for safety violations related to workplace injuries. Yet public discussion of these penalties has virtually disappeared from regulatory agendas. The Consumer Financial Protection Bureau, CFPB, received more than 300 complaints about Tesla's business practices related to financing and customer service, but the agency's leadership was subsequently replaced before completing its investigation into these patterns of consumer complaints. Multiple federal agencies that once had active investigations into Musk's businesses, including the Department of Justice, Securities and Exchange Commission, Environmental Protection Agency, and Consumer Financial Protection Bureau, have seen their leaders replaced, fired, or stripped of authority following their pursuit of regulatory enforcement actions. This pattern has occurred across diverse regulatory domains, suggesting a coordinated approach to removing oversight barriers rather than isolated coincidences in individual agencies. Critics suggest this represents more than coincidence, potentially indicating a systematic approach to removing regulatory barriers that might otherwise constrain Musk's business activities. The pattern raises fundamental questions about how Musk has managed to navigate regulatory systems so effectively, and who might be facilitating the dismantling of oversight mechanisms designed to protect public interests, worker safety, and financial market integrity. Former regulatory officials have expressed alarm at the apparent coordination across multiple independent agencies. The relationship between Musk and the Trump administration appears to have created a power network with tangible benefits for Musk's companies. The SEC had ordered Musk to pay $150 million for stock violations related to misleading public statements, but the SEC chair was subsequently replaced before full implementation of compliance measures. The Department of the Interior clashed with Musk over environmental concerns related to SpaceX launch sites in environmentally sensitive areas, but now appears to have diminished authority in these matters following leadership changes. The Federal Election Commission was investigating Musk's political funding activities before its leadership changed and the investigation stalled. While Musk presents himself as an opponent of government corruption, his critics argue his actions reveal a different story, one where legal and regulatory barriers disappear to accommodate his business interests through what appears to be systematic influence over regulatory appointments and priorities. The $2.4 billion FAA contract originally awarded to Verizon is now shifting to SpaceX without the competitive bidding process typically required for government contracts of this magnitude, raising questions about procurement integrity and fair competition for government resources. Investigations into Musk's companies across multiple regulatory agencies have stalled or disappeared entirely following leadership changes at those agencies. This pattern extends beyond coincidence, suggesting potential coordination to shield his business interests from regulatory consequences. Officials responsible for enforcing corporate accountability have been removed, replaced, or stripped of power, effectively ensuring Musk's businesses remain insulated from regulatory consequences that would apply to other companies operating in the same sectors. From allegations of stock manipulation to labor violations, the challenges Musk's companies have faced seem to dissolve before reaching resolution. Critics question whether this pattern reflects the innocence of his business practices or indicates the regulatory system is being reshaped to accommodate his interests. Government ethics experts note that this apparent preferential treatment undermines public confidence in regulatory systems and potentially creates unfair competitive advantages that distort markets and harm consumers. As these developments continue to unfold, the implications extend beyond individual contracts or regulatory decisions. They raise fundamental questions about fairness in government contracting, the independence of regulatory agencies, and whether powerful business interests have gained undue influence over the systems designed to ensure corporate accountability and protect public interests. The concentration of regulatory accommodation across multiple independent agencies suggests a coordinated approach that potentially threatens the integrity of government oversight systems designed to protect workers, consumers, investors, and the environment. The pattern of regulatory accommodation coincides with Musk's increasing political influence and financial contributions to key political figures. While direct causation is difficult to establish, the timing and consistency of regulatory relief across diverse agencies raises legitimate questions about whether wealth and political connections are determining factors in regulatory enforcement rather than consistent application of laws and regulations. This potential corruption of regulatory processes threatens fundamental principles of equal treatment under law that underpin democratic governance and market economies. These concerns extend beyond partisan politics, as government accountability experts from across the political spectrum have noted the unprecedented nature of these regulatory accommodations. Former officials from both Republican and Democratic administrations have expressed alarm at the apparent coordination across independent regulatory agencies that traditionally maintain strict separation to ensure objective enforcement of laws and regulations. This suggests a new model of regulatory capture that could potentially extend beyond Musk's companies to benefit other politically connected business interests at the expense of public protections. The implications for market competition are equally concerning. When one company appears to receive preferential regulatory treatment, It creates unfair advantages that can distort entire markets. Competitors facing stricter enforcement of the same regulations must bear costs that the favored company avoids, potentially leading to market concentration, reduced innovation, and ultimately harm to consumers through higher prices and fewer choices. This undermines the fundamental principle that markets function best when rules are applied consistently to all participants. For government contracting specifically, the apparent shift of the $2.4 billion FAA contract raises questions about whether taxpayers are receiving best value for their investment. Competitive bidding processes exist specifically to ensure government agencies select the most qualified and cost-effective providers for critical services. When these processes are circumvented, taxpayers potentially pay more for lower quality services, while politically connected companies receive windfall profits at public expense. The long-term consequences extend beyond individual contracts to potentially undermine public trust in government procurement systems. As these patterns continue to emerge, the question becomes whether existing oversight mechanisms can effectively address these concerns. Congressional committees with oversight responsibilities face partisan divisions that complicate investigations into potential regulatory capture. Independent watchdog organizations lack enforcement authority to compel document production or testimony. Media organizations attempting to investigate these patterns often face resource constraints and access limitations. This creates a perfect storm where accountability becomes increasingly difficult despite mounting evidence of systematic regulatory accommodation benefiting specific business interests.